As the effects of the pandemic have led to record inflation around the world, even the traditionally inflation-resistant Eurozone has not been spared. While until recently Europe's biggest problem had been deflationary pressures, unprecedented shocks to the real economy forced the European Central Bank to engage in massive quantitative easing, causing record-breaking inflation across the continent. At their latest interest rate decision-making meeting last week, the ECB chose to leave the benchmark interest rate at 0%, despite inflation of over 5% in the Eurozone. In other words, the ECB doesn't believe the real economy can stomach even a quarter-point hike in rates. How did markets react to this news? Most major European equity indices sold off Friday as investors began dumping European government bonds, pushing government financing costs to spike. Italy and Greece, for example, saw their bonds sell off, with the latter finally yielding more than US government bonds, while Italy is still incredibly priced by markets as less risky than US government bonds. Obviously, there must be something we're missing, as until recently, Italy and many of its banks were in deep financial trouble, right? So what's the explanation? The ECB's supercharged quantitative easing has kept these bond yields so artificially low that they have completely disconnected from reality. Something's gotta give, right? If the past is any indication of the future, choppy waters almost certainly await the Eurozone as the reality of prolonged inflation hits home.